Hello, good morning, good afternoon, and welcome to the third instalment of this podcast series brought to you by Hedge Week in collaboration with SEI Investment Manager Services. In this third instalment, we'll be looking at how retail platforms, led by Amazon, could influence the way that asset managers think about the client experience and place the investor at the centre of the relationship. One where they take a more active role in how they interact with fund managers and take greater control of the overall experience. Joining me today, I'm delighted to have Julien Messias, co-founder of Quantology Capital Management, where Julien is also the head of research and development and portfolio manager. Quantology is a Paris-based quantitative asset management company which uses proprietary data and algorithms to explore behavioural biases in financial decision making. Also joining today's panel, the two co-authors of the latest SEI white paper, which is entitled Amazonization. We have Ross Ellis, Vice President and Managing Director of the Knowledge Partnership Investment Manager Services at SEI, and Steve Unzicker, Founder and Managing Director of Anzu Research, both of whom have been on our previous two podcasts. So delighted to have everybody on board today and looking forward to today's discussion. I'm just going to get Steve to kind of introduce this latest paper just to get, again, maybe a sense of what the main aim of the paper was, Steve, and how that fits in really with the rest of the papers in the series. So what are we looking at with this latest paper on Amazonization?
Right. So this is one of 5 disruptive trends that we identified in the industry, which is part of our effort to sort of look at trends that have been disrupting other industries and how it might apply to financial services. So with Amazonization, we dug into the issue of platforms, which aren't anything new per se in the industry, but the scope and scale of something like Amazon is of course something that we've never seen. So we wanted to look into how or if or when something like that might happen in asset management and all of the implications. So yeah, that's about it really.
Okay, and there's some interesting background in the paper on the just the tremendous growth that we've seen in Amazon, and really, well, yes, it's just been quite an incredible story really. I was quite amazed that it now owns 38% of e-commerce. I mean, that's just extraordinary. So it's a great example for us to use for how we may think about applying this platform model, Ross, to the wider asset management industry. And what would be your opening kind of thoughts on that, and how maybe the industry may take a lesson, take a leaf out of the book of how Amazon have disrupted really the whole client experience?
When you actually look back at kind of the premise of why we did these papers, you go back to the financial services industry has been quite profitable over the years. It hasn't really been disrupted because it really didn't have to be. It did a lot of things well, and in a lot of respects the barriers to entry were not that high, and it was a good revenue source. But then you look back 100 years, society's been dramatically reshaped by inventions, TV, antibiotics, nuclear energy, things like that. And now we're looking at IT as the main driver of invention, and it's transforming cultures, economies. And what we're looking at to our client base is, to be visionary, you need to look beyond the markets and workings in which we all operate. And you then look at an Amazon. They started out as being an online bookstore. Now, I think they said 5% of their earnings, their revenues, come from books, and the rest come from other, other projects, solutions, and initiatives. So you look at that and how they've transformed themselves. You turn it back to the financial services industry, and it's, we need more bridges to other industries and disciplines. We've seen what can happen in Silicon Valley. We've seen what can happen in healthcare. We see a lot of today's disruptors and competitors coming from the margins or from firms in the tech industry. So you look at some point, as Bezos said, his opportunity is your margin. So when you look at how robust the margins are, even though we're under some cost pressure and fee pressure now, especially with index funds and passive, it's still a good industry to be in. So there will be more competition, and it is inevitable that the financial services industry is going to change, as it has been changing over the last decade or two. And the more society has got into social media, you have Facebook and Instagram and all these other platforms. We as consumers are used to these things. We're used to getting instant gratification. We're used to getting a high level of customer service. We're used to getting peer ratings in the community. So as consumers, investors are still consumers. Investment managers are still consumers. We are now being affected by these things that are going on outside of the industry. And it's, wow, if I can get this, I can go onto Amazon Prime and buy a kettle, Belgian chocolates, and a television, and I can get them all tomorrow. Why should I have to wait a month to get a good detailed fund report? Why can't I get that now? And so it is inevitable that the industry's level of customer service is going to be ramped up, because that's what we're all expecting from just consumers.
That's very interesting. And Julien, I'll bring you in to get your thought on that, because basically it's hard to ignore the influence that these platforms like Amazon have now on our daily lives, really, and that instant interaction that one is able to get, that's becoming the expected norm now. I wonder what you make of that, and what Ross is suggesting there, that this will influence and shape the way that that fund managers operate in the years to come, and really put the investor really front and center of the experience.
That's a very good point. I mean, because as of today, the customers, the fund holders, only receive informations at best once per month, or for hedge fund, it can be once per quarter. So if they get the information on a more frequent basis, I mean, let's say every day, every week, this means that their way of holding the position will change. I explain. 20 or 25 years ago, people did not have access to internet. They only look at the stock quotes in the newspapers. You had no market watch, no website in which you can get financial information on a very easy basis. And what was the implication? The implication of what I call the democratization of the financial information is that now you can see that people are much more flexible. I mean, they are more likely to change their position today than they used to be 25 years ago. Because as of today, they're able to check their position, they're able to change if they want, and this means that the holding position of the global market had dramatically decreased. I mean, the easier the information to get, the shorter the holding period. So if we face in the next few years what you call Amazonization of the financial industry, with data becoming much easier to get for all the investors, whether either the professional or the non-professional. What you will have as a main impact will be, once again, the decrease of the holding period. I mean, in terms of asset management, and you can see already the first impact with actors such as Robinhood, for example.
Right.
Robinhood and Robinhood enable people to access trading wherever they are. I mean, they can be in the subway, they can be outside, they can be working. They have access. They have a very easy access to their portfolio, and they can buy, sell whenever they want, whatever they want. Okay, and in addition to that, Robinhood provide the possibility to the investors to trade not stocks but even part of stocks. So it helps it helps investing to become much easier for everybody. And in fact, if we are able to create, if we see a big platform such as an Amazon of financial services emerge, then we'll face the same consequences, meaning that you will have much more people, much more players, I would say, professional and non-professional, because the data is very easy to handle. And the consequences for the asset managers is that you will have to face much more volatile, customers, and those people will ask you as an asset manager more and more services.
Steve, I'm quite keen to bring you in here on, I think, the Robinhood story from last week and the week before with GameStop. I think it's an interesting one when we think about how maybe some of these platforms may start to grow and metastasize. And I suppose really we saw the volatility that came as a result of that, where these Reddit groups were deliberately, short squeezing hedge funds, and we saw it with silver. We saw the silver price rocket as well. But really quite sharp volatility, Steve. Is that something that we need to be cognizant of when we talk about maybe this platform evolution coming into financial markets?
Well, yeah, I think we do need to be cognizant. I'm not sure any of us really know how it's going to shake out. And there are lots of interesting things going on with that, with the GameStop situation, especially because there's sort of this confrontational ideological element involved there. Some people would say that there is also just an old-fashioned pump and dump scheme at work there underneath it all. So, it's sort of hard to say, but I do think that underlying all of it is this issue that Julien was talking about, which is very important, which is, ease of access and information liquidity and, the democratization of data, and, the resulting interest in shorter holding periods and active trading and all of that. So, a platform like Amazon in financial services, to the extent that it promotes real-time feedback and allows interaction with information, not just daily, but but in real time, how does that how does that change the way people invest, either individuals or institutions? Presumably big institutions are going to keep their longer investment horizons, but if day trading, which used to be a kind of a niche activity, becomes the norm for a lot of people, I mean, you have to assume that it's going to roil the markets in ways that you are alluding to, and that in turn is going to have an impact on how institutions invest as well. So, there'll definitely be knock-on effects. It'll just be interesting to see how it all, plays out.
I think. Sorry, was that Julian there? Oh, sorry. No, I thought I thought I heard something there. No, I think that's a good point, and I suppose really, if we think about a much freer exchange of data, it's certainly in the retail investor space, those that are using platforms like Robinhood, there is that risk that it is going to introduce a lot more volatility, simply because of the day trading activity, Steve, that you referred to. And I suppose that's maybe part of the limitation that maybe is at play here, that a platform like Amazon is ultimately a retail platform, Ross. So are there limitations to what we could expect as asset management firms, to think about the platform model and what they could realistically achieve, given that for the big institutional investors, they don't want that free flowing transfer of data and information. It can demonstrably harm them.
Yeah, actually, I have two answers that are potentially non sequiturs. One of the things that we had talked about earlier was about Amazon's acquisition of Twitch, which is a video gaming platform. One could easily see how that's a gaming platform. A lot of gamers would look at what Robinhood and Reddit did as a game, and you could easily see that the esports aspect of Twitch can be converted to stock market gaming. That wouldn't be that hard of a push. But what you're seeing today, Roaring Kitty, the trader, and the Robinhood CEO are at Capitol Hill talking to lawmakers about what happened. Yeah, was that a bait and switch? Was it was it an illegal operation that, all of a sudden you're used to gaming, you're used to something, but now you're stepping into the field of financial services where there's regulations. They're now a financial company. It's a bigger deal. So, you could see though over time that video gaming culture where you have people who just go online to watch other people play. So you could see how, hey, maybe I'm not a trader, but I'm going to go online and I'm going to watch other people trade, and I can see them doing short squeezes, and hey, this looks like fun. So certainly we can see how volatility can increase based on individuals grouping together. But you look at the market as a whole, an individual trader cannot roil the market compared to the big institutions. But when you join together, as a lot of these gamers do, you can cause some, you can cause something a little disruptive.
I mean,
but we've also,
yeah. Sorry, Ross, go on.
No, I say, but we've also seen, right, institutions who are very, very, very well known in their space. They're looking to branch out, get new streams of revenue. They're looking to get a new investor base. So, that's why fund supermarkets, blew up, not blew up, got bigger and bigger, because they're firms that didn't have brand recognition. They just wanted to have a different revenue stream. They wanted to diversify their asset base. And sure, they could go onto a retail-based platform, and obviously they have to worry about cannibalizing their own solutions, but you could have parallel distribution channels, parallel distribution efforts that can benefit everyone. So you're both democratizing investing by giving institutional quality solutions to the retail investor, at the same time that the institutional manager is getting additional streams that they would never have got before.
Yeah, that's. There is, I will bring Julien in just a minute, but I just want to ask Steve very briefly on, just to finish this point, how important though, Steve, it's fascinating what Ross is alluding to there with the video gaming concept that could apply. And I could really see that happening. For any of these big financial institutions that adopt a more of a platform type model, though, they have got a fiduciary responsibility, and this really, as your paper alludes to, the reputation and the trustworthiness is so integral to what they're doing that has to be central to any kind of concept of growing any sort of a platform type model. Do you have a view on that?
Well, yeah, and it is more complicated, than retail, without a doubt. But that, it doesn't mean that it's not going to happen. It just means that technology has to be in place to support, these more complex and fragile and meaningful relationships, right? So, and I don't mean to imply that these trends that we were talking about sort of just bring chaos to the markets. I mean, I think in some ways, you look at Amazon, and it brings a lot of order to that market. And, you could even look at other analogies which might be even more pertinent, like online matchmaking services, right? Match.com, or or even Tinder or something like that. Well-designed platforms like those, they take a lot of the pain and the chance and the happenstance out of matchmaking. So, you could imagine benefits like that really standing out in financial services. I mean, who wouldn't sign up for a better experience and a superior result, right? So, I think in terms of fiduciary responsibility, that that dovetails very nicely. And then in terms of the actual technology, maybe blockchain offers one way forward there. Smart contracts and some of these decentralized finance protocols, they already mean that you have trustless transactions that are possible. And it all seems very daunting to some of us, but maybe it's generational to a certain extent. Once we can get past some of our own biases, I think the sky's the limit there.
Well, that concludes part one of this latest podcast. Some great thoughts shared by the panel there, and do join us for part two coming up soon.